Yo, what's up, guys? Welcome to day 4 of reading The Big Short. 30 minutes of reading. We're gonna continue from where we left off. In chapter 2, the In the Land of the Blind, paragraph 2. Let's get started. Timer starting now. So you take something like Nova Star, which was an originate and sell subprime mortgage lender, an archetype at the time. The name of the bond would be nil 2004 1, nil 2004 2, nil 2004 3, nil 2005 1, etc. Nil 2004 1 would, for instance, contain loan for from the first few months of 2004 and the last few months of 2003, and 2004 2 would have loan from the middle part, and 2004 3 would get the latter part of 2004. You could pull these prospectus and just quickly check the pulse of what was happening in the subprime mortgage portion of the originate and sell industry. And you see that 2 over 28 interest only ARM mortgage were only 5.85% of the pool in early 2004, but by late 2004 there were 17.48% of the pool, and by late summer 2005 25.34% of the pool. Yet average FICO consumer credit score of the for the pool percent for no doc liar loan to value measure and other indicators were pretty static. The point is that these measures could stay roughly static, but the overall pool of mortgage being issued, packaged, and sold off was worsening in quality, because for the same average FICO scores or the same average loan to value, you were getting a higher percentage of interest-only mortgages. As early as 2004, if you look at the numbers, you could clearly see the decline in lending standard. In Burry's view, standard had not just fallen but hit bottom. The bottom even had a name: the interest-only negative amortizing adjustable rate subprime mortgage. You, the home buyer, actually were given the option of paying nothing at all and rolling whatever interest you own the bank into a higher principal balance. It wasn't hard to see what sort of person might like to have such loan: one with no income. What Burry couldn't understand was why a person who lent money would want to extend such a loan. What you want to watch are the lenders, not the borrowers, he said. The borrowers will always be willing to take a great deal for themselves. It's up to the lenders to show restraint, and when they lose it, watch out. By 2003, he knew that the borrower had already lost it. By early 2005, he saw that lenders had to. A lot of hedge fund managers spend time chit-chatting with their investors and treat their quarterly letters to them as a formality. Burry disliked talking to people face to face and thought of these letters as the single most important thing he did to his investors know what was up to what he was up to. In his quarterly letter, he coined a phrase to describe what he thought was happening: the extension of credit by instrument. That is, a lot of people couldn't actually afford to pay their mortgage the old-fashioned way, and so the lenders were dreaming up new instrument to justify handing them new money. It was a clear sign that lenders had lost it, constantly degrading their own standards to grow loan volume. Burry said. Burry said he could see why they were doing so. He could see why they were doing this. They didn't keep the loan, but sold them to Goldman Sachs and Morgan Stanley and Wells Fargo and the rest, which packaged them into bonds and sold them off. The end buyers of subprime mortgage, he assumed, were just dumb money. He studied up on them too, but later, He now had a tactical investment problem. The various floor or tranches of the prime mortgage bond all had one thing in common: the bond were impossible to sell short. To sell a stock or bond short, you need to borrow it, and these tranches of mortgage bond were tiny and impossible to find. You could buy them or not buy them, but you couldn't bet explicitly against them. The market for the prime mortgage simply had no place for people in it who took a dim view of them. You might know with certainty that the entire subprime mortgage bond market was doomed, but you could do nothing about it. You couldn't short houses. You could short the stock of home building companies, Paul's Home, say, or Toll Brothers, but that was expensive, indirect, and dangerous. Stock price could rise for a lot longer than Burry could stay solvent. A couple of years earlier, he discovered credit default swap. A credit default swap was confusing mainly because it wasn't really a swap at all. It was an instrument policy, typically on a corporate bond with semi-annual premium payment and a fixed term. For instance, you might pay $200,000 a year to buy a 10-year credit default swap on $100 million in General Electric bond. The most you could lose was $2 million, $200,000 a year for 10 years. The most you could make was $100 million. If General Electric default on its debt anytime in the next 10 years, the bondholder recovered nothing. Hmm. It was whoa. The most could 100 million. I'll make 100 million. If General Electric default on its debt anytime in the next 10 years and bondholder recover nothing. It was a zero sum bet. If you make 100 million, the guy who had sold you the credit swap default swap lost 100 million. It was also an asymmetric bet, like laying down money so a number on a number in roulette. The most you could lose were the chip you put on the table, but if your number came up, you made 30, 40, or even 50 times your money. Credit default swap um, remedied the problem of open end risk for me, said Burry. If I bought a credit default swap, my downside was defined and certain, and the upside was many multiples of it. He was already in the market for corporate credit default swaps. In 2004, he began to buy insurance on companies he thought might suffer in a real estate downturn. Mortgage lenders, mortgage insurer, and so on. This was entirely satisfying. A real estate market meltdown might cause these companies to lose money. There was no guarantee that they would actually go bankrupt. He wanted a more direct tool for betting against the prime mortgage lending. On March 19, 2005, alone in his office with the door closed and the shades drawn, reading an abstract textbook on credit derivatives, Michael Burry got an idea. Credit default swap on the prime mortgage bond. The idea hit him as he read a book about the evolution of the US bond market and the creation in the mid 1990s at JP Morgan of the first corporate credit default swap. He came to a passage explaining why banks felt they needed credit default swaps at all. It wasn't immediately obvious, after all. The best way to avoid the risk of General Electric defaulting on its debt was not to lend to General Electric in the first place. In the beginning, credit default swap had been a tool for hedging. Some banks had loaned more than they wanted General to General Electric because General Electric had asked for it, and they feared alienating a long-standing client. Another bank changed its mind about the wisdom of lending to GE at all. Very quickly, however, the new derivative became tool for speculation. A lot of people wanted to make bets on likelihood of GE's defaulting. It struck Burry. Wall Street is bound to do the same thing with the prime mortgage bond too. Given what was happening in the real estate market, and given what the prime mortgage lenders were doing, a lot of smart people eventually were going to want to make side bets on the prime mortgage bond, and the only way to do it would be to buy credit default swap. The credit default swap would solve the single biggest problem with Mike Burry's big idea: timing. The subprime mortgage loan being made in early 2005, where he felt almost certain to go bad, but at their interest rate was set artificially low and didn't reset for 2 years. It would be 2 years before that happened. The prime mortgage almost always bore floating interest rate, but most of them came with a fixed 2-year teaser rate. A mortgage created a mortgage created in early 2005 might have a 2 year fixed rate of 6% that in 2007 would jump to 11% and provoke a wave of defaults. The faint ticking sound of these loans would grow louder with time, until eventually a lot of people would suspect, as he suspected, that they were bombs. Once that happened, no one would be willing to sell insurance on the prime mortgage bond. He needed to lay his chips on the table now and wait for the casino to wake up and change the odds of the game. A credit default swap on a 30-year prime mortgage bond was a bet designed to last for 30 years. In theory, he figured that it would take only 3 to pay it off. The only problem was that there was no such thing as credit default swap on the prime mortgage bond. Not that he could see. He'll need to prod, prod the big Wall Street firm to create them. But which firm? If he was right and the housing market crashed, this firm in the middle of the market was sure to lose a lot of money. There was no point buying insurance from a bank that went out of business the minute the insurance became valuable. He didn't even bother calling Bear Stearns and Lehman Brothers, as they were more exposed to the mortgage bond market than the other firms. Goldman Sachs, Morgan Stanley, Deutsche Bank, Bank of America, UBS, Merrill Lynch, and Citigroup were, to his mind, the most likely to survive a crash. He called them all. 5 of them had no idea what he was talking about. 2 came back and said that while the market didn't exist, it might one day. Inside of 3 years, credit default swap on subprime mortgage bond would become $1 trillion market and precip- precipitate hundreds of billions of dollars worth of losses inside big Wall Street firms. Yet, when Michael Burry um, pestered the firms in the beginning of 2005, only Deutsche Bank and Goldman Sachs had any real interest in continuing the conversation. No one on Wall Street, as far as he could tell, saw what he was seeing. He sensed that he was different from other people before he understood why. When he was 2 years old, he had developed a rare form of cancer, and the operation to remove the tumor had cost him his left eye. A boy with one eye sees the world differently than everyone else, but it didn't take long for Mike Burry to see his literal distinction in more figurative terms. Grown-ups were forever insisting that he should look other people in the eye, especially when he was talking to them. It took all my energy to look someone in the eye, he said. If I am looking at you, that's the only time I know I won't be listening to you. His left eye didn't line up with whomever he was trying to talk to. When he was in social situation trying to make chit chat, the person to whom he was speaking would steadily drift left. I don't really know how to stop it, he said, so people just keep moving left until they are standing way to my left and I'm trying not to turn my head anymore. I am now facing right and looking left with my good eye through my nose. His glass eye, he assumed, was the reason that face to face interaction with other people almost always ended badly for him. He found it madden- maddeningly difficult to read people's nonverbal sign and their verbal sign. He often took more literally than they meant them. When trying his best, he was often at his worst. My compliment tended not to come out right. He said, I learned early that if you compliment somebody, it'll come out wrong. For your size, you look good. That's a really nice dress. It looks homemade. The glass eye became his private explanation for why he hadn't really fit in with groups. The eye oozed and whipped and required constant attention. It wasn't the sort of thing other kids ever allowed him to be unself-conscious about. They called him cross-eyed, even though he wasn't. Every year they begged him to pop his eye out of his socket, but when he complied, it became infected and disgusting and a cause of further ostracism. In his glass eye, he found the explanation for other traits peculiar to himself. His obsession with fairness, for example. When he noticed that pro basketball stars were far less likely to be called for traveling than lesser players, he didn't just holler first at the refs. He stopped watching basketball altogether. The injustice of it killed his interest in the sport. Even though he was um, ferociously competitive, well built, physically brave, and a good athlete, he didn't care for team sports. The eye helped to explain this, as most team sports were ball sport, and a boy with poor depth perception and limited peripher- peripheral vision couldn't very well play ball sport. He tried hard at less ball centric position in football, but his eye popped out if he hit someone too hard. Again, it was hard for him to see where his physical limitation end and his psychological one began. He assumed the glass eye was at the bottom of both. He couldn't stand the unfairness of coaches who favored their own kids, umpire who missed call drove him to distraction. He preferred swimming, as it required virtually no social interaction, no teammates, no ambiguity. You just swim your time and you won or you lose. After a while, even he ceased to find it surprising that he spent most of his time alone. By his late 20s, he thought of himself as the sort of person who didn't have friends. He had gone through Santa Teresa High School in San Joe, UCLA, and Vanderbilt University School of Medicine, and created not a single lasting bond. What friendships he did have were formed and nurtured in writing. By email, the two people he considered to be true friends he had known for a combined 20 years, but had met in person a grand total of 8 times. My nature is not to have friends, he said. I'm happy in my own head. Somehow, he had married twice. His first wife was a woman of Korean descent who wound up living in a different city. She often complained that I appeared to like the idea of a relationship more than living the actual relationship. And his second, to whom he was still married, was a Vietnamese American woman he had met on Match.com. In his Match.com profile, he described himself frankly as a medical student with only one eye, an awkward social manner, and $145,000 in student loan. His obsession with personal honesty was a cousin to his obsession with fairness. Obsessiveness that was another trait he came to think of as peculiar to himself. His mind had no temperate zone. He was either possessed by a subject or not interested in it at all. There was an obvious downside to his quality, He had more trouble faking than most faking interest in other people's concerns and hobbies, for instance. But an upside too. Even as a small child, he had a fantastic ability to focus and learn, with or without teachers. When it synced with his interests, school came easy for him, so easy that as an undergrad at UCLA, he could flip back and forth between English and economics and pick up enough pre-medical training on the side to get himself admitted to the best medical school in the country. He attributed his unusual power of concentration to his lack of interest in human interaction. And his lack of interest in human interaction, well, he was able to argue that basically everything had happened was caused one way or the other by his fake left eye. This ability to work and to focus set him apart even from other medical students. In 1998, as a resident in neurology at Stanford Hospital, he mentioned to his superior that between 14 hours hospital shift, he had stayed up 2 nights in a row taking apart and putting back together his personal computer in an attempt to make it run faster. His superior sent him a psychiatrist who diagnosed Mayberry a bipolar. He knew instantly he had been misdiagnosed. How could you be bipolar if you were never depressed? Or rather, if you were only depressed while doing your rounds and pretending to be interested in practicing as opposed to studying medicine? He had become a doctor not because he enjoyed medicine, but because he didn't find medical school terribly difficult. The actual practice of medicine, on the other hand, either bored or um, dis- disgusted him. Of his first brush with girls' autonomy, one sense with people carrying legs over the shoulder to the sink to wash out the faucet just turned my stomach. I was done. Of his feeling about the patients, I wanted to help people, but not really. He was a genuinely interested he was genuinely interested in computers not for their own sake, but for their service to a lifelong obsession, the inner working of the stock market. Ever since grade school, when his father had shown him the stock table at the back of the newspaper and told him that the stock market was a crooked place and never to be trusted, let alone invest in. The subject had fascinated him. Even as a kid, he had wanted to impose logic on this world of numbers. He began to read about market as a hobby. Pretty quickly, he saw that there was no logic at all in the charts and graphs and waves and the endless chatter of many self-advertised market pro. Then along came the dot-com bubble, and suddenly the entire stock market made no sense at all. The late 90s almost forced me to identify myself as a value investor because I thought what everybody else was doing was insane, he said. Formalized as an approach to financial market during the Great Depression by Benjamin Graham, value investing require a tireless research for companies so unfashionable or misunderstood that they could be bought for less than their liquidation value. In its simplest form, value investing was a formula, but it had morphed into other things. One of them was whatever Warren Buffett, Benjamin Graham's student, and the most famous value investor happened to be doing with his money. Barry did not think investing could be reduced to a formula or learned from any one role model. The more he studied Buffett, the less he thought Buffett could be copied. Indeed, the lesson of Buffett was to succeed in a spectacular fashion, you had to be spectacularly unusual. If you are going to be a great investor, you have to fit the style to who you are, Barry said. At one point, I recognized that Warren Buffett, though he had every advantage in learning from Ben Graham, did not copy Ben Graham, but rather set out his own path and ran money his way by his own rule. I also immediately internalized the idea that no school could teach somebody how to be a great investor. If it were true, it would be the most popular school in the world, with an impossibly high tuition, so it must not be true. Investing was something you had to learn how to do on your own, in your own peculiar way. Barry had no real money to invest, but he nevertheless dragged his obsession along with him through high school, college, and medical school. He reached Stanford Hospital without ever taking a class in finance or accounting, let alone working for any Wall Street firm. He had maybe 40K in cash, against 145K in student loan. He had spent the previous 4 years working medical student hours. Nevertheless, he had found time to make himself a financial expert of sort. Time is a variable continuum, he wrote to one of his email friends on Saturday morning in 1999. An afternoon can fly by or it can take 5 hours. Like you probably do, I productively fill the gaps that most people leave at that time. My drive to be productive probably cost me my first marriage, and a few days ago almost cost me my fiance. Before I went to college, the military had this. We do more before 9 a.m. than most people do all day. And I used to think, and I do more than the military. And I used to think, and I do more than the military. As you know, there are some select people that just find a drive in certain activities that supersede everything else. He wasn't bipolar, he was merely isolated and apart, without actually feeling lonely or deeply unhappy. He didn't regard himself as a tragedy. He thought, among other things, that his unusual personality enabled him to concentrate better than other people. All of it followed in his mind from the wrapping effects of his fake eye. That's why I thought people thought I was different, he said. That's why I thought I was different. Thinking himself different, he didn't find what happened to him when he collided with Wall Street nearly as bizarre as it was. Late one night in November 1996, while on a cardio- cardiology rotation at St. Thomas Hospital in Nashville, Tennessee, he logged on to a hospital computer and went to a message board called Textdot.com. There he created a thread called Value Investing. Having read everything there was to read about investing, he decided to learn a bit more about investing in the real world. A mania for internet stock gripped the market. A site for Silicon Valley investor, circa 1996, was not a natural home for a sober-minded value investor. Still, many came all with opinion. A few people grumble about the very idea of a doctor having anything useful to say about investment, but over time he came to dominate the discussion. Dr. Mike Berry, as he always signed himself, sensed that other people on the thread were taking his advice and making money with it. Once he figured out he had nothing more to learn from the crowd on his thread, he quit it to create what later would be called a blog, but at the time was just a weird form of communication. He was working 16-hour shift at hospital, confining his blogging mainly to the hours between midnight and 3 in the morning. On his blog, he posted his stock market trades and his argument for making the trade. People found him as a money manager at Big um, Philadelphia Value Fund said. The first thing I wondered was, when is he doing this? The guy was a medical intern. I only saw the non medical part of his day, and it was simply awesome. He's showing people his trade, and people are following it in real time. He's doing value investing in the middle of the dot com bubble. He's buying value stocks, which is what we're doing. But we're losing money, we're losing clients. All of a sudden, he goes on his tears. He's up 50%. It's uncanny. He's uncanny, and we're not the only ones watching it. Mayberry couldn't see exactly who was following his financial move, but he could tell which domains they came from. In the beginning, his reader came from Earthlink and AOL, just random individual. Pretty soon, however, they weren't. People were coming to his site from mutual funds like Fidelity and big Wall Street investment bank like Morgan Stanley. One day he let into Vanguard's index fund and almost instantly received a cease and desist order from Vanguard's attorney. Berry suspects that serious investor might even be acting on his blog post, but he had no clear idea who they might be. The market found him, says the Philadelphia mutual fund manager. He was recognizing patterns no one else was seeing. I think that's it for today. I'll read it more tomorrow. See you guys in the next video, part 5.